Good morning. Give a few minutes for others to arrive and we'll get rolling. Good morning, Jamie. I did receive your email. I'm going to send you some links to help you with that calculator. In fact, I'm going to write myself a note. You're welcome. We're going to get back into talking about Chapter 7. Last week, like I said, nobody showed up. So I posted for you to listen to the video that I have created for Chapter 7 on how we determine the cost of a bond, how much it's going to sell for. So today I want to get back into talking about Chapter 7, wrap up talking about the other issues related to bonds, the different types of bonds. We're going to look at the bond market, how you can determine if a bond should be, how it's rated, if you're going to be okay with buying it, depending on what you as an investor want to see from it, and how interest rates are really determined. So we have a full docket. So let's get right into it. I'm going to share my screen. I'm going to go back to my PowerPoint. Okay, let me do this. Share. There we go. I want to make sure you guys can see it. Okay, so let me get my slideshow going. So I rearranged the slides for actually last week's lecture. So they're a little bit out of order from what you guys were watching on the video presentation, but I want to come back and make sure we understand what a bond is. Basically, a corporation, in order to raise funds, will sell equity or bonds, liabilities. So to the corporation or to the US government, because the US government sells bonds as well, and so do state and local governments. They're selling a liability. What's a liability? Well, it's something that they're going to have to pay back. So the bond indenture is you can look at it as the loan document or contract between the entity selling the bond and the bondholder, the entity purchasing the bond. Essentially, what's happening there is that the entity purchasing the bond is loaning money to the entity selling the bond. So because of that, the entity that is selling the bond, the corporation or the US government, has to do some stuff. And what's the stuff they have to do? Well, that's identified in the contract, or what we call the bond indenture. So you can look at it as the loan agreement. This holds up in a court of law. There's basic information on this. How long does the purchaser of the bond have to wait for their money? So when will the bond mature? What's the total amount of the bond issue? So I see there's a chat. Uh-oh, you guys can't hear me? Let me see. 1 minute.
And Let me share my screen. Okay, sorry about that. Just, that's a new headset I got. It's wireless, so it might be sensitive to being touched or whatever. Maybe I am. Okay, so back to this contract between the entity selling the bond and the entity purchasing the bondholder, we call those. So other information that will be on this contract that they create is if there's any kind of security on the loan. In other words, if there's any kind of collateral being used for if the bond is defaulted on. So if the corporation selling the bond does not pay off the bond at the end, what's the repercussions? What can the bondholder do? There might be something called a sinking fund provision. We'll talk about that. A call provision. There could be what's called detailed covenants. So all this information is defined on the contract, just like when you have any loan document. Other information on there will be the principal. So let's take a look. And I'll come back to this in a second. The principal amount of the bond, and we define the principal as the amount that will be repaid when the bond matures. Because a corporation sells this contract and says, we will pay you this much at the end. That's the principal. That's the maturity or principal. They also call it the par and face value. During the life of this loan, we're also going to pay you interest, bondholder, at this interest rate. Now it could be once a year or it could be twice a year. But we call that the coupon rate or stated interest rate. Then we have the maturity date, and that's the day the bondholder will receive their money. And there's also, and you learned about this from the lecture, what we call the yield or yield to maturity. And we also refer to that as the market interest rate. So that's basically the interest rate that bonds will sell at. And that's what we use to determine the selling price of the bond. And you went through that video where you were learning how to take the two major components of a bond, the interest payment and the principal, and determining what their values are today using the yield to maturity rate. And it's that amount the bonds will sell for. So a bond doesn't sell for its par value automatically because the interest rate that's being paid on the bond may be different than what a person buying it wants it to be. The selling price will either be more, the same, or less. And that selling price is that interest rate, the rate of return required in the market for a bond like it. So that's why we use the yield to maturity rate to determine the selling price of the bond. And go through that video again, but that's essentially what you're doing. Now, let's go back to this screen. Bonds have different type of characteristics, and we saw some of them in that bond indenture. They could be registered versus bearer. Registered means that the current owner is being kept track of by the corporation. So the corporation is always tracking when that bond is being sold and whoever the new owner is. They will then send any interest payment to that new owner. So it's very hard to lose a bond like this because we always know who the prior owner was. A bearer bond is different, and these used to be very popular, but they're not as popular now. A bearer bond, the owner is a person who holds the coupon book or the loan contract. So there's no official name change back at the corporation. They don't even keep track of the names. So these are more, you know, they're harder to keep track of who owns them, because it's whoever owns them, whoever holds that coupon book owns them. And they're also very easy to lose. So, but they are another form a bond could take. There's different types of characteristics when it comes to security. Some bonds are sold with collateral attached to them. What does this mean? Well, just like when a person takes a loan for a mortgage for a home, they use their home as collateral for the loan, meaning if they default on the mortgage, the bank could take their home as collateral, as the asset. The same thing with a bond, but it's usually financial securities. So, you know, a corporation sells bonds with, they own stock in another corporation. Corporation ABC sells bonds. They use stock they own of XYZ as collateral on the bonds. So if Corporation ABC defaults and never pays the bond's principal back, the bondholder could come and take that stock they own of XYZ Corporation. Sometimes the security is with real estate, so real property. So maybe the corporation says, well, we're going to use a different asset as collateral. We're going to use a piece of land we own or a building we own as collateral. They call this a mortgage security, just because of the type of property that's being used as collateral. There's bonds that don't have any security, and that's a lot of them. They're called debenture bonds. They're unsecured. So what does that mean? The person or the entity purchasing the bond is buying it on the full faith and trust that the entity selling the bond will pay them interest and their principal back when it matures. Now we're going to talk about this in a few minutes. Like, why would somebody just do that? Well, we can check and see on the credit worthiness of a corporation and the bond they are selling. So you don't have to buy this blindly. It's just a lot of bonds are sold this way. And then there's also, they will refer to bonds as notes that are unsecured debt with original maturity less than 10 years. So it's just how long it takes to mature. It's just a different reference we would use for a bond. It would be called a note. So most bonds are long-term. They're going to be more than a year, 10, 15, 20 years from the date of the sale to the date the bond matures. The final area right now on this slide is seniority. So different bonds have what's called different seniority when it comes to repayment. So on page 209, when debt is what we call subordinated, okay, it means that that debt, say in bankruptcy, would be paid after other debt. So there's a seniority as to how debt would be paid. So you can purchase a bond with higher seniority or what we call junior seniority, which is subordinated. Okay, so it's just the way the debt would be paid if there's a default, meaning the bond doesn't get, the corporation doesn't pay, maybe they go into bankruptcy, and now the courts have to decide. Well, you took a back seat because you took subordinated debt. So that's all that means. But that's defined in that indenture. Do you guys have any questions on any of that? All right, going on then. Okay, so that's stuff you should have looked at. Any questions on determining the selling price of a bond? Okay, so before we, well, let me go into here. Okay, so. Okay, so hopefully you could hear me again. All right. As I said, there's differences between debt and equity. Now we're focused on debt in this chapter. Next chapter, we're going to focus on stock, which is equity. But we want to make sure we remember and understand the difference. When a corporation sells a bond, they're not selling ownership in the company. They're now creating a debtor-creditor relationship. And I always refer to it as corporations, but remember, governments can sell bonds as well. A creditor, so the bondholder has no voting rights. They're like the bank. They will receive interest, and it's usually tax deductible. They have a legal recourse if those interest or principal payments are missed, so they can sue the corporation for the money. Excess debt can lead to financial distress and bankruptcy from the entity selling the bonds perspective. So they take a lot of risk as well. Next chapter, we'll talk about equity. Now that's an ownership interest, and they're usually stockholders who can vote people in. So now they're owners. Dividends, which are paid to stockholders, versus interest that is paid to bondholders. Interest is tax deductible by a bondholder, or I'm sorry, it's tax deductible by the corporation. Dividends are not. Dividends are not a liability to the entity selling them or paying them. And that's usually the corporation. And stockholders have no legal right to receive them. They can't say, like an interest payment, a bondholder can come back to the corporation or the government and say, you owe me interest by a contract, that bond indenture. When you own stock, you can't do that. You're kind of just waiting to see when the corporation decides to give you a dividend. And all equity firms cannot go bankrupt merely due to debt, since it has no debt. What does this mean? Well, a corporation that issues bonds now has debt, meaning they owe the money. And that could lead them into financial distress. Think about right now, corporations that have bond issues, bond sales, okay, and they're not operating, or they're operating and making less money than they normally do. They may have a problem right now paying interest payments. That could lead to financial distress and bankruptcy, and they're required by their loan contract, that indenture, to do that. Where a company that only sells stock to finance it doesn't have that issue. They don't have to, by contract, pay anything. So that's what they're referring to in that point. So we're focused over here right now in this chapter. Now, some more characteristics. The coupon rate, so that's the rate on the bond, really depends on how much risk is associated with that bond. Now, just so we know, the day an entity decides we need to raise money with a bond, we need to sell a bond or a bunch of bonds and raise some money. And from a corporate perspective, it's the board of directors of the corporation that gets together and decides this. And they say, well, how much money do we want to raise? And they come up with a dollar amount. They could have went to the bank, but they decided, no, we want to sell bonds. We're going to do that. Then they have to start looking at the different risks dependent on the characteristics of their bond and determine a coupon rate of interest on the bond. How much interest should we pay on this bond? And they're going to look at these various things. But you need to understand something. That occurs maybe today, which is April 14th. They may not sell that bond till June 1st. Lots of things could change, as we have seen in the last couple of weeks. I mean, we had dramatic changes, but even in our normal everyday life where we don't have catastrophic things happening with our economy, things happen, things change. So that's why sometimes, and a lot of times, the bond doesn't sell for what its principal is at the end. So the bondholder who buys a $1,000 principal bond doesn't always pay $1,000. And I talked about that a little earlier. And part of the reason, okay, they try to develop a coupon rate that's on the bond in stone. That's what we're going to pay in interest, that will hopefully mirror how people are looking at that interest rate when they actually sell it, but that doesn't always happen. So we can't change, the entity selling the bond cannot change the interest rate on the bond. They can't, they're locked in. That's a contract. We don't grab our white out the day we're selling the bond and go, oh, things change, let's make it a different interest rate. We're locked in on that. So because of that, we have to change the selling price. Okay, and that's why we see these bond prices be different than the principal. What causes our coupon rate to be where it's at? Well, it depends on the characteristics of the bond. Is this bond a secured debt or a debenture? So the more security there is on the bond, the lower the interest rate, because the lower the risk associated with that bond. Where a debenture bond has more risk. So the higher the coupon rate will be on that bond. Subordinated debt versus senior debt. Subordinated debt has more risk because they get paid second. So they tend to have a higher coupon rate than senior debt. A bond with a sinking fund versus one without. So let's talk about what a sinking fund is. A sinking fund is a requirement on the bond contract that the corporation create a savings account basically and save the money to pay off the bond over time. But they're required to do it, and it's part of the contract. So what's the other alternative? The corporation doesn't save up, and hopefully they have the money to pay off the bond when it matures. So a bond with a sinking fund characteristic on it, where that corporation is required to save up their money, will have less risk associated with it versus one without. So the coupon rates will be different. A callable bond versus a non-callable. So this is just another characteristic that's associated with a bond. A callable bond is one that the entity selling the bond, borrowing the money, has the option to allow, it's usually them that say, we're going to pay off that bond early. We're not going to wait till it matures. We're going to pay you a certain amount during a certain period of time if we feel like it. So there's that option that the bondholder may get their money before maturity. You have to remember something, and this goes back to economics too. The longer the money is outstanding, the more risk associated with getting your money back. So the longer the time is from the date of the sale of the bond to maturity, the more risk there is with the bondholder getting their money. So if there's a chance you could get your money here, less risk. I should say right there, right? You have less risk. So that coupon rate will tend to be lower. A non-callable bond, you have to wait till the end to get your money. There's more risk that you won't get your money. So the coupon rate on the bond will tend to be higher because of that risk. And you're going to demand that as a purchaser of a bond. So people buying these bonds will demand a higher coupon rate on these, or a higher interest rate, because of these types of risks that they're buying. Now, as I said, there are bonds out there. Let me see if I wanted to go back before I see, one more thing. No, okay. Let me go back to this. There we go. So when we buy a debenture, a bond that has no collateral attached to it, we're going into this kind of scary, and we're saying, are we going to get our money back? Really, with any bond, you got to be a little scared. Are we going to get our money back? What kind of risks are associated with it? And if you don't know or study the corporation, you really don't know. So there's companies out there like Moody's, Standards and Poor's, that provide a investment quality bond rating. And they talk about this on your pages 211. So you could buy a bond feeling somewhat comfortable. I mean, it's not a 100% guarantee, but you could feel comfortable with the ability for you to get your money back. So assess your risk. So Moody's has what, it's a AAA, but it's a capital A with two, lowercase, uppercase and two lowercase A's. And S&P, Standards and Poor's, they have a AAA. And that rating, and they have the different rates on page 211, but that one is the capacity for that issuer to pay their interest and principal is extremely strong. So that's the highest grade bond, lowest risk. Then it goes to a AA, and that is very strong. So it says, gives you more information in your text. It's a very strong capacity to pay interest and repay principal. Together with the highest rating, this group comprises the high grade bond class. So those are very good ratings. So if you're looking to buy a bond, you may want to look depending on what level of risk you want to take. Now, no, these bonds are going to have a lower coupon rate because the risk is not as high. Medium bonds. Now we're getting into the A's. These are defined as your capacity to pay interest and repay principal is strong, although it is somewhat more susceptible to adverse effects of changes in circumstances and economic conditions than debt in higher rated categories. So these are medium grade, we call these. And then they get into B, Moody's goes to a B, AA, Standards and Poor's is BBB. So the capacity to pay is adequate, adverse conditions will have more impact. So now it's getting more risky. Low grade, you can see, considered possible that the capacity to pay will degenerate. So now you're getting into very risky. And then very low grade, Moody's C and below, S&P C and below. These are what we call income bonds with no interest being paid, or you're going to be in default. These bonds are already in default and they haven't been paying interest. Interest in arrears means they have missed interest payments on these bonds. Okay, so you have to remember they're going to rate them the first sale date, but then they're going to continually rate them because they're still being traded in a market, as you read in chapter 7. Bonds have an active bond market, which we're going to look at in a second. Okay, so it's very important that there's a rating system to help investors determine how they should and where they should invest their money. So there is guidance. Now, as I said, those bonds, those bond ratings though are for corporate bonds. Government bonds, we have different type. There's treasury securities, and this is a heavy bond market. This comprises a lot of the bond market, it's government bonds. So the federal government sells bonds. You might hear them referred to, there's one, treasury bills. These are what we call pure discount bonds with an original maturity of 1 year or less. What does this mean? They sell them for one price, which is usually lower than maturity or at a discount, and they pay off a higher price at maturity, or the maturity value. Treasury notes. This is coupon debt with original maturity between 1 and 10 years. So now you're getting interest, and the maturity date, coupon debt means you're receiving an interest payment. The original maturity is between 1 and 10 years. So that's just what they refer to. Remember, we said notes before. Bonds sometimes are referred to as notes if the maturity is less than 10 years. Treasury bonds, you're receiving interest payments, but the maturity is greater than 10 years. So they just differentiate those two types of government bonds as notes or bonds dependent on maturity. So the federal government is selling those, as well as municipals. Government. So Luzerne County sells bonds. The different, I know my one friend is a business manager in one of the local governments. He was talking to me a couple of years ago. I saw him out. He goes, "We're selling a bond issue." I'm like, "Oh, wow." You know, we just hated learning about it when we were in accounting school. But they do, to raise money, just like a corporation would. So the degree of default risk is rated similar to corporate debt. And I remember, you watch the news, Luzerne County is always posting about their bond rating, their credit rating. So these are very real things. Now, what's nice about municipal securities, which you don't have with any other type of bond, so a municipal bond, state and local bonds, compared to federal bonds and corporate bonds, is the interest payment a bondholder receives is not taxed at the federal level. So that's how they try to entice people to buy bonds at the local and state level to fund the governments there by not making that interest taxable for federal purposes. So just some more types of bonds that could be sold and purchased. So let's just take a look at this really quick. The tax situation here. So let's say you have some money. There's a taxable bond that has a yield of 8% interest. So when you buy that bond, over the life of the bond, you're going to make 8% in interest. You also can look at a municipal bond, and that bond has a yield of 6%. So that's how much interest it's actually going to make over the life of the bond. So when you're looking at this, you might go, should I buy one that yields 8% or 6%? Just don't pick the 8%, because you have to remember something. The bond in the 8% yield is taxed. The bond in the 6% category is not taxed for federal purposes. So if you're currently in a 30% tax bracket for federal purposes, so your income, your dollars of income at the end, the very last dollar of income was taxed at 30%. Which bond should you buy? Well, think about this. How much money are you really making? If you are getting 8% interest, 30% of that is going to be taxed. So 30% of that money is gone as tax. How much are you really making? Well, 1 minus 30%, or 5.6% return. We call that the after-tax return. So you're not really making 8% yield because of that tax component of that interest. You're really only making 5.6%. So you should take that money and invest in the 6% return municipal bond. You're actually making more of a return over the life of the bond, more money than you would buying that 8% taxed bond. And when we say taxed bond, we just mean the interest is being taxed as you receive it, bondholder. So what would be, at what tax rate would you be indifferent to the type of the two bonds you bought? Well, you could figure this out. You could say, okay, I know the corporate bond that will be taxed is 8%. So I need, at this point, a tax rate that would allow me to make 6%, just like the municipal bond. So if you take 8% times 1 minus t, or 70%, you need 1 minus t. So you would have to divide it out. Your t tax rate would need to be 25%. So at any point that your tax rate is 25% or lower, buy the taxable bond, because you're going to make more money over the life of the bond. Your yield will be more than 6%. But at any point your tax rate is above 25%, the municipal bond should be purchased. So that's just another way to determine which is the better investment. And you always have to take taxes into consideration. Are there any questions on that? Okay. Now, another type of bond that could be sold. We call them zero coupon bonds. Zero, none, no coupons. Coupons are always referred to as the interest. Now, if you're going, who would buy a bond where there's no interest? Well, if you ever have bought a US savings bond, you've bought a zero coupon bond. Okay, so what happens? We discount or remove all of the interest out of the final payment, maturity payment, and sell it without any interest in it. So that means you're not going to get interest payments over the life of the bond, but you bought it at such a deep discount, it's okay. The difference between what you pay for it, bondholder, and what you get at the end, that's the interest. So the entire yield to maturity or interest comes from the difference between the purchase price and the par value or maturity value you will receive. These cannot be sold for more than their maturity value. They're sometimes called zeros, deep discount bonds, or original issue discount bonds. Treasury bills and principal only treasury strips are just some examples of investments of zeros. Now, before I move on from that, because I could freak you out a little bit, I know, go to page 214 of your book. And I just want to show you the interest. I'm going to stop sharing my screen and go into the book and pull this up, top of page 214. Give me a second to grab my book here. Sorry. Okay, so here we are where I want to be here. This is the top of page 214. This shows you how we determine the actual interest on the bond each year. So years ago, I forget what the exact, before 1982, corporations and bondholders, okay, because corporations have interest expense when they have these type of bonds, and so do governments, and bondholders have interest income, even though they aren't actually receiving an interest payment each year. Because remember what we said, the difference between the maturity value, which in this case is $1,000, and the beginning value, which is the sale price of $508.35, that difference of $491.65 is the interest component. Well, you need to recognize as interest income bondholder a portion of that each year. You don't wait till the end. So what they said to do was, well, divide the total difference and recognize an equal portion each year. That was called straight line. Bondholder would recognize that as interest income on their tax return. Corporation would recognize it as interest expense on their books. But then the federal government came in and said, no, that's not really good. We want you to do it a different way. And they came up with what's called the implicit interest. I'm not going to get into the whole calculation there. I'll just show you the first one. I lied, okay? But we calculate the interest more exact. And what we do is, and you can do this calculation, is we take the beginning balance right here of the bond. So in this case, 508.35 times, let's see what they give up here, the yield it sold for. Well, this bond has a maturity of 1,000, and you could do this in your finance calculator if you don't know it. So how much interest, what is the interest rate on this bond? Well, you use your present value and future value calculations. So you go into your finance calculator. This is a 5-year bond, so N would be 5. We need to calculate the interest. The present value is what it sold for. So I'm going to put that in as a negative 508.35. The future value is the maturity of 1,000. I'm going to put that in an S positive. Then I'm going to use my cursor, go back up, alpha, enter. Okay, that's not what I wanted. Oh, okay. It comes up as 14%. But the assumption here is they're using a, looks like a semi-annual, whatchamacallit, compounding. Let me just take a quick look here. Okay, no, I was right. So it comes up to be, I was right on my, hold on one second, let me get back in there. 14.48%, or if you wanted to use 14.49%. So that's what the bonds sold to yield. Okay, that's the interest rate on it. So each year, to calculate the amount of interest, what you do is you take that beginning value of the bond, 508.35 for the first year, times that 14.49%, and that's the amount of interest that would have occurred on the bond and would be recognized. That interest you recognize increases the value of the bond to calculate the second year's interest. So the second year, you're going to take 508.35 plus 73.66. Multiply that by the 14.49%, and that'll give you your second year's worth of interest. So it's just a different way of calculating the interest. The third year, you would add the 84.33 to the 582.01 to get the new value to calculate the third year's interest. Are there any questions on that? I'm going to go too crazy with it. I just want to make you aware of that. Okay, that's zero coupon. Share my PowerPoint back with you. Okay. Okay. There's also floating rate bonds. This means that as the interest rate changes in the world, the interest rate on the bonds will change. So the interest rate isn't locked in at the contract rate on the bond. The bond is set up that it says, we're going to change the interest rate for your bond payments over the life of the bond, depending on where the interest rate is for certain types of securities. Sometimes they're linked to inflation. Now, there may be what's called a collar. And what that means is the interest rate can never go above a certain amount on these floating rate bonds or below a certain amount. So they have what's called a ceiling and a floor. So the rate adjusts dependent on some type of index value. So it could be treasury rate, it could be some kind of interest rate that's stated in the finance world. And if that interest rate goes up, the bond coupon rate will go up, but it may only go up to a certain point and never higher. And that depends if there's this, what we call a collar or a ceiling and floor put on the rate. So we just want to make you aware that that's also what could happen. And we're still talking about types of bonds here, right? There are bonds that are set up for catastrophes. So this is really interesting. I have in my book here. Insurance companies will set these up. They will set up bonds in case there's some kind of a major catastrophe. The risk involved with buying this kind of bond, so they're saving the money for the catastrophe, is that the catastrophe happens. What's very interesting is that since 1997, when these types of bonds were first issued, 4 times they have not been paid in full. So that's over what, almost 25 years, 20 years, 23 years. And the reason, one was because of Hurricane Katrina, which was a major catastrophe. And the other one was a tsunami in 2011. So the risk associated with this is for major catastrophes. Now, this might be one of them, what's happening. But I'm not sure how affected insurance companies would be by an economic catastrophe. These are more natural catastrophes we're talking about. But bonds could be issued to protect companies from these catastrophes. The bondholders willing to take on the risk. Income bonds. This is when interest is paid based on how well the company does. Convertible bonds. Convertible bonds are bonds that at maturity or at some time before can be converted into stock. So the corporation usually selling the bond will say, oh, we will pay you either cash, or if you want, you could have some of our common stock. Put bonds. This allows the holder to force the issuer to buy back the bond at a stated price. And other kinds. Your book talks about reverse convertible. I like the death bond. Those are like pretty gory and eerie and weird, but they sell bonds. Insurance companies will do this. Sell bonds that are paid off from life insurance proceeds when the policyholders pass away. So you're taking a risk on how, as a bondholder, how long a person is going to live. You'll get your money when they die. Okay? Just to let you know that there's all these different types of provisions that could be put into a bond, characteristics. I'm probably not going to pronounce it right, but I'm going to pronounce it the way I think. A SUKUK are bonds that have been created to meet a demand for assets that comply with Sharia law, because Sharia law does not permit the charging or paying of interest. Okay, so it's just another type of bond because of Islamic law and cultural traditions. So if you've ever seen that term, That's what it is and why they are different. Okay, so all the different characteristics, bond ratings. Any questions on any of those? So let's talk about the markets that they're actually sold in. Bond markets are primarily OTCs, over the counters, with dealers connected electronically. So there's not a market like the New York Stock Exchange. It's primarily all computerized. There's extremely large number of bond issues, but generally very low daily volume in single issues. So although there is a large number of bond issues, there's not a lot of trading. So what's hard is it's very hard to get up-to-date prices on bonds, especially on small company or municipal issues. Now, for a long time, they weren't required to make bond prices even transparent at all, okay? But over the years, in 2002, there was the trade reporting and, in 2002, new regulations required that the reporting of bond prices become more transparent. And they're to report it through the trade reporting and compliance engine. We're going to take a look at that. Okay, so now it's much easier to see how bonds are selling, what prices, and different information about them. So I'm going to take a run out to FINRA's Market Data Center. Okay, and that's the financial industry. Let me make sure you can see it. There we go. The Financial Industry Regulatory Authority, they give us a snapshot from TRACE, the Trade Reporting and Compliance Engine, by reporting the most active issues. So here's some information. Market at a glance. There's Caterpillar, Bank of America, Apache Corporation, Escom Holdings Ltd. We're going to take a look at some other bond, the one in your book, a matter of fact. So you can come out here and get information. Here's market activity. Okay, how much changing it, the corporate bond trading, treasury, that's government. Okay, and you could see Fannie Mae's one, Freddie Mac. Okay, so there's all kind of information out here. It's available now where before it wasn't. If you want to learn more about bonds or do a search, you can do a search for bonds in here as well by corporate, government, securitized, and municipal even. So all kind of bond issues are out here and information related to them. Now, this is the finra.org Morningstar. Top of page 221, and I'm going to grab it in your book. Okay. Let me grab 221 we're on. There we go. So here is how you would see bonds quoted, okay, on the trade reporting and compliance engine. You could see here's Comcast. They all have symbols. The coupon rate, remember that is the interest rate on the bond itself, saying we're going to pay you 3.3% of the principal once or twice a year, depending on the bond, until it matures. The maturity date. The bond rating. So you can see there's our rating system in action, Moody's, Standards & Poor's, and there's even Fitch it's called. what they sold at, their high, 101.357. So that's above the principal. Remember, principal is 100%. This sold at 101.357. Low, it sold below principal, 99.422. The last price, 99.633. So these prices are always quoted as a percentage of the par value. So if the par value on this is 1,000, that's how much is going to be paid at maturity. You would multiply the $1,000 by 0.99633. So this sold for $996.33 last. The lowest it sold at is $994.22. And the highest is $1,013.57. Then it gives you the percentage change. And then it should give you a yield here, because the yield is what it's actually selling to earn over the life of the bond. Remember, it's the yield that determines this price. So if we look at these pharmaceutical that sold at 3.15%, take a look at its rating and then take a look at what it yields. So people are going to demand more over the life of the bond. Buyers are going to demand more over the life of the bond than the coupon rate when you have that kind of rating. That's a medium grade. That's even getting into low grade. And so, but this is interesting, okay? For whatever reason, this bond's coupon rate is 4.5, but it's much higher. So it's, people are only demanding about 4%. Look at, they're demanding about the same for bonds that have the similar type of risk. And that's what naturally happens. So since this pays 4.5% or more than people are demanding to receive, people are paying a little bit more for them, 102. So that's how market rate, or I'm sorry, I call it market, but it's the yield, what people want to make compared to the coupon will affect the price. So I know I went a little off kilter there, but let's take a look at one more. So here we have Microsoft is only paying 3.7% on this. People want to make 4%. So the bond price is less than maturity or par, and that's what happens. So take a look at that and you can see those relationships that were discussed earlier in the chapter. Now, let's take a look at, that's corporate bonds. Now let's look at United States Treasury notes and bill prices, or bond prices, I'm sorry, bill. So this is cited a little differently. So we have the maturity here. How many, so then we can figure out how many years. The coupon, so that's what the interest rate is. The bid, now dealers buy these bonds and sell them. So it's very private. So the bid price is what a dealer is willing to pay for the bond right now. Because they're going to buy it and then they sell it. They just don't bring a buyer and a seller together, a dealer. They purchase it just like a car dealer does. They don't go, oh, I found a car for you and you and this other company can buy and sell it and I'll just take a commission. A dealer buys the product and then sells it. So they're going to bid. That's the most they'll pay for it. The asking is the most the dealer, or the lowest the dealer will sell it for. That's the lowest. So it's just cited and recorded a little differently. And then the asked yield. So that's what people want to make on it. So you can see down here where the yellow line is. Okay. Bonds with a 4.5% coupon rate, okay, the asking and the bid are the same at about $128. And these types of bonds will yield 2.618. So remember, the bid and asking, of course, is decided by the dealer, but based on how much they feel they can sell it for. And they want to make sure they can make a profit on it. So it's just how they're presented when it comes to US Treasury and notes. So just a different quoting system. I'm going to go. Any questions? All right. Here's what we just talked about. Make sure I'm sharing with you. I don't see you guys. Okay. Whoops. Go back to my. Okay, we looked at that. Okay. One last thing to talk about before we focus on interest rates for our last 15, 20 minutes. When bonds are selling, there's what's called a clean price. A clean price is the quoted price. So what the bond is actually selling for based on its yield. There's also what's called a dirty price. And it doesn't mean it's bad or anything. It's just what we call the price actually paid. And here's why. When entities are buying and selling bonds to each other, they don't buy and sell them on the interest date that the owner of the bond received the interest. They could be happening at any time during the time interest is occurring on that bond. So a dirty price includes what we call accrued interest. Now, before I show you how to determine it, I want to show you a picture of it. Okay, so let me end that so this makes more sense. And go into Word. Bear with me a second. Share this. Okay. Let me give you an example. Let's say a bond that has a 5% coupon rate of interest and a $1,000 par value pays interest on December 31st each year. Okay, so the bond's coupon rate of interest, that's how much they use to calculate the actual interest payment that is made to the bondholder on December 31st, it's 5%. So every December 31st, whoever owns the bond will get 5% interest. $1,000 times 5%, you know, do it, times 1 year's worth of interest. What you have to remember about interest is interest occurs every second of every day. It's constantly occurring. It's constantly what we call accruing or adding up. So let's say bondholder A sells this bond to person B on April 1st of the current year. Okay, so bondholder A sells this bond to person B on April 1st of the current year. The clean price, or the one that's quoted, is 101. Okay, what is the selling price of the bond? It's not just 101 times 1,000. First, you calculate the clean price. The clean price is the 1,000 times 1.01. Or $1,010. Now, the next thing we have to look for is any interest that has accrued or added up since the last interest payment date. So let's calculate that. 1,000 times 5%, or 0.05, times 3/12. Because the last time interest was paid to bondholder A was on January 1. They've held this bond for 3 more months, never received this interest. So 1,000 times 0.05, $12.50. What's important to remember is that at the end of the year, when person B still owns this bond, they're going to receive a check for $50 as if they own this bond for the entire year. The corporation isn't sitting there going, oh, how many people own this bond during the year? Let's figure out how much interest goes to that person and that person and that person. They don't do that. Whoever owns the bond on the interest payment date gets the full check. Now, does person B, are they really entitled to all $50? Did they own that the entire year? No, but they're going to receive all $50. So to make up for that inequity, the selling price of the bond will be the clean price plus the part of the interest bondholder A is entitled to. So you're going to charge that extra beyond the quoted price. So this bond will really sell for $1,022.50. So that's what they mean by that, because that's always happening. And like I said, the corporation doesn't sit there and go, how much should we pay to this bondholder? How much should we pay to that bondholder? Whoever owns it gets the money. Any questions on that? Okay. Let's go back and wrap this up. So they give you that's the calculation I just did. So you can see that. Okay. So let's talk about interest rates. How did they come up with these interest rates? Well, first of all, taking it back to your economics class, right? We have real rate of interest, which measures your change in purchasing power. So it includes inflation effect in the interest rate. And then we have nominal rate of interest, which is just the quoted rate of interest. And this measures how much your dollars change, not your purchasing power. So the Fisher effect, because a lot of people want to know not only, hey, how much dollar-wise will this interest rate change, but my purchasing power change. And let's just take a quick look at it on the bottom of page 223. We want to make sure you understand the difference here. To see the effect of inflation, suppose prices are currently rising by 5%. So the inflation rate is 5%, right? Inflation is price increase. You have the ability to get an investment that will pay you $115.50 in 1 year. It costs $100 today. So your rate of return on this is 15.5%. But this is considered a nominal rate. It's just measuring your dollar change. What's your inflation effect? Well, let's take a look at this. Suppose pizzas cost $5 today. So with that $100 you could have invested, you would have bought 20 pizzas. If inflation is at 5%, by the end of the year, they're going to cost $5.25. So how many pizzas can we buy with that $115.50 that money will accumulate to? Well, now we can only buy 22 pizzas. So this rate of return is 10% because you can only buy 20 pizzas at the end, 22 or beginning, 22 at the end. So from an inflation perspective, your rate of return is 10%. So even though our money, our nominal rate of interest is 15.5, so we'll have a whole $15.50 more. It doesn't buy us 15.5% more in pizzas. It only buys us 10% more in pizzas. So this is just showing you the difference between the two rates. So the real dollar value of our investment in a year is $115.50 divided by 1.05, the inflation rate, or $110. So take a look in the middle of the page. The nominal rate on an investment is the percentage change in the number of dollars, where the real rate of interest, real rate takes into effect inflation, is the percentage change in how much you can buy. So we have these two different rates here. Inflation, real, okay, and nominal. And the Fisher effect explains the relationship of these. And in the end, here's what it says. The nominal rate of interest, okay, the nominal rate, which is represented with R. So what should your rate be? The real rate plus inflation. Real rate plus the inflation rate. Take a look at the example on page 225. If the investors require a 10% real rate of return and the inflation rate is 8%, so they want a return on their investment, their purchasing power, they want it to be 8% or 10%, I'm sorry. So they want their real rate of return to take into account inflation to be at 10%, and the inflation rate is 8%. What must be the approximate nominal rate? So what rate should be being offered on this investment? What kind of investment return are you looking for? 18%. So it's helping us to approximate where we need to be when we're looking at our investments and how nominal rate and real rate impact each other. And inflation is just so important, and that's just the example I just went through. Finally, let's see if I have time. You know what, I think I'm gonna do my finally, because this is a good thing to start Thursday's class with. It's just two or three pages we still have to look at. We're gonna look at how are these interest rates even determined? What kind of components are involved? What are bondholders thinking about and doing to create these interest rates? And like I said, we'll wait and do that on Thursday. But do you guys have any questions right now on chapter 7? Remember, I have the other recording out there too. I'll get this posted. We're going to finish up that last little piece of chapter 7, and then we're going to get into chapter 8. So you want to start making sure you look at the smart book for chapter 8. And that's where we now are going to start talking about, okay, we saw how to value bonds. Now we're going to look at how we value stock. Where does the stock price come from? We'll take a look at a couple different methods of doing that and the different features related to the different types of stocks, how stocks are traded on the stock exchange, things like that. Okay, all right then, guys. Thanks everyone for coming out. And if you have any questions before Thursday, you can email me. If not, I will see us on Thursday. Have a great day.